to today's seminar. I am Asyakostanyan from the Better Policy Project, and I will be your moderator today. So today we will discuss the paper Inflation Targeting in India, a further assessment by Barry Eichengreen and Poonam Gupta. This paper reviews India's inflation targeting regime at the 8-year mark. Let me introduce our speakers and our discussant. Barry Eichengreen is a professor of economics and political science at the University of California, Berkeley. He is also a research associate of the National Bureau of Economic Research and a research fellow of the Center of Economic Policy Research. Poonam Gupta is the Director General of the National Council of Applied Economic Research and a member of the Economic Advisory Council to the Prime Minister. And our discussant is Jose Vicente Romero, a researcher at the Banco de la República, a central bank of the Republic of Colombia. He has also served as head of markets development at the Banco de la República and director of macroeconomic and sectoral analysis at Pedesarolo. The paper we are going to discuss today finds that the Reserve Bank of India has been effective in reducing and stabilizing inflation while improving monetary policy transmission. It also suggests updating the weight of food prices in the CPI basket. So without further ado, please join me in welcoming our distinguished speakers.
Thank you very much. Barry and I have decided that I'll go first. I'll take about 12 to 13 minutes and then Barry will step in. So let me connect the slides and then we can take it from there. All right. So I assume the slides can be seen. Perfect. So that was a very kind and comprehensive introduction to the paper. Thank you for that. Thank you also for your invitation. In the abstract, or more than the abstract, in the title itself, we have admitted that it's a further assessment, which means that we did an assessment exactly 4 years ago. And what we are doing really is that we are using each of the 2 milestones in the inflation targeting framework's life in India to do these assessments. The first milestone was when the first Monetary Policy Committee completed its 4 years. And another milestone is that every 5 years, the government itself reviews the framework. That turned out to be a little bit of a non-event because the government concurred with everything that is being done in the framework and there were no changes suggested. Now, another milestone that has now happened is that this month, a second MPC would be completing its term. So it has been now 8 years and a new Monetary Policy Committee is being set up. And we thought that we should go back and look at our results and see whether they have withstood the test of time. So this is what the paper is about. A little bit of introduction. India adopted inflation targeting in September 2016. And as I just said, it's completing 8 years into it. There was a little bit of the work behind it. The RBI Act had to be amended in the parliament. There was a very nice comprehensive report that was produced at the time by the Deputy Governor of the Reserve Bank of India, Urjit Patel, which laid out the features of inflation targeting as adopted in other countries, the challenges that might come along while implementing it, and what have been the benefits. And it also proposed a specific structure of how it could be implemented in it. Most of those recommendations were accepted by the government. And so it was implemented eventually after nearly 2 years worth of work in October 2016, when the first MPC committee was set up. What were the key features of the framework? As in most other countries, the framework was around targeting the headline consumer price inflation, CPI, There were debates at that time whether the country would be better served by targeting core inflation or wholesale price inflation, for the reasons that Barry will reflect more upon, that food is a large part of consumption basket, or it certainly was a larger part 8 years ago, and food prices tend to be volatile. So the monetary policy should not be beholden to volatile food prices, which in any case move by supply side considerations rather than demand side considerations. It targeted an inflation level of 4% within a band of 2 to 6%. It is called a tolerance band, that the RBI would target a 4% inflation but would be tolerant of it if inflation varies between 2 to 6%. Compared to other countries, it's a wider band, and it has remained so. The Monetary Policy Committee was to be constituted for 4 years, and it had to have 6 members, 3 of which would be the central bankers, the governor himself or herself. As it so happens, India still does not have, hasn't had a female governor, so I can say he. So the governor himself and the deputy governor in charge of monetary policy, as well as one other member, and 3 external members to be selected by the government. Repo rate was going to be the key policy rate. So the committee had to have at least 4 meetings in a year. The way the inflation targeting was implemented, there are now 6 meetings in a year that are held. The calendar of the meetings is announced in advance, and these are about every 2 months. There have been 49 meetings that have been held till now. COVID was an interesting period, almost midway through these 8 years. There have been 22 meetings pre-COVID, 27 meetings post-COVID. The last meeting was held just last month. The first meeting of the new MPC would be held in early October. There has been only one out-of-turn meeting that was held, I think around 22, if I'm not wrong. And then there are other details about whether there have been too many decisions in these meetings, whether the decisions have been in any particular direction, be it tightening or loosening of monetary policy and so on. In a subsequent slide, we actually compare some of these statistics pre and post IT. So I have already mentioned a little bit of why an interest in this paper and in monetary framework at this point, because of the fact that a 3rd committee is going to be set up. But also because there have been some interesting discussions in India at this time on the relevance of the framework itself and whether the framework is serving the monetary policy or the wider economy well. There have always been some skepticisms around the framework, as would be the case in any other country. And in particular, that skepticism currently is on whether headline inflation is appropriate for India to target, or is it time to reconsider some other inflation series? And as always, the options being discussed are core inflation, wholesale price inflation, or a hybrid of some kind. Specific concerns have persisted for all of 8 years. The record and delivery of inflation targeting framework notwithstanding. These concerns are that by putting an unduly large weight on inflation, perhaps this framework neglects other considerations such as output gap or exchange rate. Food has a large weight in CPI index, about 45%. And therefore, monetary policy is excessively influenced by volatile food prices. One issue that has been raised in the past and has not gotten a whole lot of attention this time is that whether a 4-point target is too low for a developing economy. Would India not be served better by a higher inflation target such as 5%? And whether the framework is nimble enough to respond to shocks. So what we have done in the paper is we look at more or less at each one of these concerns. And in order to do so, we estimate the reaction function and we ask whether the weight on inflation in the monetary policy reaction has increased after the adoption of inflation targeting. We also compare the economic outcomes, a number of economic outcomes pre and post inflation targeting. We analyze the properties of different inflation series, and we ask whether there is a strong case for targeting core inflation versus headline inflation, as is done currently. We also ask whether food price inflation has played an unduly large weight in monetary policy decisions. While doing all this, we also compare India's structure of inflation targeting with that of other countries. And we have in particular selected some of the large emerging markets, which might be considered as India's peers. And we ask whether India's inflation targeting framework compares favorably with those. And then we have a section on policy lessons, which Barry is I think, better suited to talk about. What are our main findings? Our main findings are that MPC and RBI has not been obsessed with inflation. And this result we find by comparing the reaction function pre and post IT. We also divide the post IT period into two halves, the first 4 years and the second 4 years. And we find that our main result withstands that division of period into two halves. If anything, inflationary expectations have become better anchored after moving to inflation targeting. A range of financial variables, including inflation itself, have become less volatile post-IT. We do an interesting, and in fact, a couple of interesting exercises around food price inflation. And we note that food price inflation is not more persistent than core inflation, and that it feeds into core inflation rather than the other way around. So therefore, ignoring food inflation can result in policy miscalculations. But we make a strong case for the fact that share of food in India's inflation basket is outdated. The inflation basket was updated more than 10 years ago, and a lot of things have changed meanwhile, including a very rapid cumulative growth in per capita income. To the extent that share of food correlates very strongly with per capita income, the current weight of 45% is clearly is larger than the correct weight would be. So just very quickly, I'll just take a couple of more minutes to talk about some of the things. So here we are comparing at 5-year intervals India's inflation rate with the inflation in low and middle income countries, the middle row, and the average inflation around the world. Historically, India's inflation rate has been closer to that of low and middle income countries and higher than the global average. There was, however, a period, 2006 till 2015, when India's inflation rate exceeded, it broke away from the inflation rate in low and middle income countries, and it exceeded that average by several basis points. And this was exactly the trigger to move to inflation targeting. Now, the last two columns show us the average inflation rate after moving to inflation targeting. And it's very clear that the gap between India's inflation and inflation in low and middle income countries, or average inflation in the world, has narrowed down. It's a very simple and very clear example of how inflation rates have converged now with that of other countries. So the first exercise we do in the paper is estimating the reaction function and asking whether the weight on inflation has increased post-inflation targeting. And here we estimate a very traditional kind of reaction function in which we regress policy rate on output gap and inflation rate. And then we have two dummies. These dummies are for two separate dummies, one each for the 4 years into inflation targeting. So IT1 takes a value 1. We are using quarterly data here for the first 4 years of inflation targeting, and IT2 takes a value 1 for the last 4 years into inflation targeting. our results look like this, that both output gap and inflation have a positive coefficients. In the regressions where we include lagged effective policy rate, the coefficient on inflation is positive and significant. When we include the two dummies for inflation targeting period, we get negative coefficients which are significant in some of the specifications. So the point being that after the inflation targeting, after the implementation of inflation targeting, both output gap and inflation have been significant determinants of policy rates. And after accounting for those, the policy rates have not increased. If anything, they have declined, which means that monetary policy has not become more hawkish, has not unnecessarily responded more to inflation than it would have. So in that sense, there is evidence of continuity rather than a discontinuous hawkish stand on monetary policy. So at this point, I'll stop and Barry will take over. So Barry, if you don't mind starting from this slide where we are comparing the number of policy actions and so on, and I'll stop streaming.
You looked at the policy reaction function pre and post inflation targeting. In addition, we look at various economic outcomes pre and post inflation targeting, starting with slide number 14. The next one. We estimate we look at the behavior of different variables, adjusting for the global financial crisis period, both during the financial crisis and after the financial crisis, since it is likely to have had a separate confounding impact on the behavior of various measures of inflation. But the takeaway here is from the first and second lines, which basically show that the various measures of inflation have been lower post-inflation targeting with the adoption of inflation targeting than they were previously, even after controlling for the financial crisis period. The next slide, number 16, then looks at the volatility of the various measures of inflation, with the same takeaway that inflation has been more stable, better behaved, if you will, since the adoption of inflation targeting, first two rows of the table. Slide number 17 then goes on and looks at the behavior of the change in the exchange rate, the volatility of the exchange rate, the behavior of foreign reserves, the behavior of secondary market interest rates, and equity market volatility. And again, the broad takeaway here is that a variety of variables that consumers and investors care about, from exchange rate volatility to secondary market yields to equity market volatility, have been less volatile, have been better behaved post-inflation targeting. Slide number 18 then looks at government bond, looks at monetary policy transmission, the pass-through of the central bank's policy rate, the repo rate, into government bond yields, treasury bill yields, bank lending rates, and et cetera. And again, shows that pass-through has been stronger, more complete, if you will. Monetary policy transmission has improved with the adoption of inflation targeting. Next slide, 19, looks at households and professional forecasters' expectations of inflation, and average inflation expectations have fallen with the adoption of inflation targeting. That fall seems to have been concentrated in the first half of the IT period for households, but spans both halves for professional forecasters. Slide number 20 then turns to the comparison between core inflation, headline inflation, food price inflation, inquires into the correlation of the different variables and poses the question of whether headline inflation is still the relevant measure for the Reserve Bank to target, or whether there is a case for targeting core inflation, as in, for example, the United States. Slide number 21 contrasts the different broad measures of inflation. And here you can see a point that Poonam made in the first half of the presentation, that food price inflation has food prices have a very heavy weight in the CPI. You can see that from the right-hand side. So a question to be asked is whether that very heavy weight is still justified given current incomes and the current structure of the Indian economy. Slide number 22 is a reminder that the different measures of inflation move together, not surprisingly, on average, but that their standard deviations are very, very different. That of core inflation is quite low. That of wholesale price inflation, on the other hand, is very high. That it is likely to make a very considerable difference for the conduct of monetary policy under inflation targeting. Which of these measures is the focus? Slide number 23 is a visual reminder of the same, that food price inflation is quite volatile in India. Wholesale price inflation is significantly more volatile than CPI headline inflation. Slide number 24 basically tells you the same thing, that there is a correlation between these variables, but it is less than complete. 25 asks which of these variables lead the others and feed through into the behavior of the others. So we look at the impact of core inflation, food price inflation on one another, with the Y variable on the left-hand side column, the X variable in the second column, and we ask in each case, does X lead to changes in Y? Does X Granger cause Y, if you will, where we consider various lags of X on Y? And the striking result here is that food price inflation does feed through into core inflation, that it does affect other variables at a lag length of 2, at a lag length of 4, not so clearly at a lag length of 8, but that result that there is an impact of food price inflation on core inflation seems to be reasonably robust, which points to the question of whether it would be safe and sensible for the Reserve Bank to disregard movements in food price inflation. We think not, to anticipate a subsequent conclusion. There is, however, the question of whether the weight of food in the consumer price index in India is excessive. So we estimate the relationship between the share of food and per capita income across countries. And we can confirm the basic result that the importance of food in the consumption basket is higher in low-income countries, but we also find that the weight in India's CPI as currently calculated is excessive, that the estimated weight of food for India, given today's per capita income, would be closer to 40% instead of the current 46% weight in the CPI. And assuming that the Indian economy continues to grow at a 7 or 8% pace over the coming decade, that 40% will decline 10 years from now to something closer to 30%. So that suggests the need to correct the weight of food prices in the CPI, and that may reassure some who are worried about the current impact of excessive weight of food prices in India's current CPI basket. Next slide, please. That's visual representation of the same, that there is this negative relationship between real per capita GDP and the weight of food and beverages in the CPI. You find this both in cross-country data and in cross-state data for India itself. Slide 28 then does basically the same thing. 29, please. Finally, we draw policy lessons from the above, asking first whether there are valid arguments for broadening the mandate of the Reserve Bank of India. So the mandate focuses relatively narrowly on low and stable inflation, but as Poonam showed before, the Reserve Bank in targeting inflation does seem to be responsive to the output gap as well. It's not an inflation nutter, to put it in Mervyn King's terms, but there have been suggestions as well for further broadening the mandate to include income distribution, to include climate goals, and the like. We think that the Reserve Bank's mandate to pursue low and stable inflation with some attention to the output gap is best served by preserving the central bank's independence, and preserving its independence requires in turn a relatively focused mandate consistent with accountability to the public and politicians. We would not support, therefore, broadening the mandate to include further goals. We think that headline CPI is still the relevant measure of inflation for the Reserve Bank, but we do think that the consumption basket could be updated so that headline CPI better reflects the inflation experienced by consumers. 4% is a reasonable midpoint for the target range in our view, higher than that, slightly higher than that experience utilized in advanced economies. And we think there are costs to fiddling with the midpoint of the target range. So we would not endorse calls for a higher mandate. The tolerance band, which ranges from 2% to 6%, similarly, we think is broadly appropriate, and we would point to costs of altering it. There have been calls in India for somehow taking into account state-level variations in inflation, which can be considerable, significant in the Indian context. The Reserve Bank has only one monetary policy instrument, if you will. It would not be easy or appropriate for it to take into account state level variations in inflation around the average. And finally, we would strongly push back against calls, which are heard occasionally, for abandoning the inflation targeting framework for some alternative. So to conclude, slide 31, we think that the inflation targeting regime has worked well. You saw that in declining levels of realized and expected inflation, and the declining volatility of a variety of financial variables. Radical changes like broadening the mandate or abandoning the target would be counterproductive. We think that the 4% target with the plus or minus 2% tolerance band remain broadly appropriate. That said, we think the regime can be adjusted slightly to improve performance by reducing the weight of food prices in the CPI. Suitably updated in this way, we think that the current inflation targeting regime should remain the framework for monetary policy in India for the foreseeable future. So with that conclusion, we look forward to Jose's comments and the discussion.
Thank you very much. Well, first of all, it's an honor to commend this paper by Professor Eichengreen and Director Gupta. I'm going to share some slides here. Can you see my screen now?
Yes, we
Okay,
can.
thank you. Well, thank you very much for this invitation. I cannot say again that it is an honor to comment these results. These are very important results for not only for India, but also it provides a nice framework for other central banks that follow inflation targeting, and it presents compelling evidence that inflation targeting has worked very well in India. These are very useful lessons for other emerging market central banks that share some of the problems and challenges that you may see in countries like India or in countries like Latin America. I just have some of the results of does it work? Okay. The main results, I'm going to go here really fast because you have already seen from the authors what they found, but in general, the adoption of inflation targeting in India has been very successful, positive outcomes like lowering and more stable inflation rates in the country, better anchoring inflation expectations that I'm going to talk in a little while, improve monetary policy transmission, improve in economic indicators like this decrease inflation volatility, and reduce exchange rate equity market volatility. Also, they have this nice discussion of food price weight on the CPI basket. I think this is particularly important, not only because of the high weight that food has on the CPI basket, but also the composition of the different kinds of food items in the index. And I want to mention this because countries like India or here in Latin America, we have a strong supply shocks driven by adverse weather. And for example, what we do here, and probably this is done in India as well, we just divide food between items that are agricultural produce that are more affected by this adverse weather shock. So also not only reducing the weight, but also checking like how this composition between different items that can be affected more by supply shocks is also useful. Also, discussion, for example, like meals outside the household, how these are affected also is important because, for example, here we had a huge discussion if we should include these in the CPI basket as a food item or as a service. Because that may create like additional spillovers of these adverse weather shocks when they affect food inflation. So this is really interesting for emerging market, and it's not only the weight but also the composition of these food items on the basket. And also it highlights the importance of maintaining the current IT framework. These are the potential reforms that in the last part, Professor Eichengreen mentioned about the broadening the mandate, where the authors said that broadening the mandate could dilute a focus on price stability, the importance of CPI as the relevant indicator and not using other core inflation measures, the importance of dating the consumption basket, the midpoint of 4%, which in the case of India looks adequate. Regarding the tolerance band, this is a question that I've always had. There's some literature regarding this on how you communicate that band, because actually it's different if you just say that people may get confused if the target is the 2 to 6% or is 4, and this is just a range that you support some kind of variance, and you are okay with that, of if the range is the target. So that may create some inflation, and that may create a little bit harder to anchor inflation expectations. So also this discussion is very interesting. The same with the state level variations. I agree with this conclusion. It creates more problems if you just start focusing on this kind of regional variation, and the importance of the continuation of inflation targeting. The main suggestion that I would like to see in the paper is regarding with this, and actually I think it will be great because Professor Eichengreen is the leading figure talking about transparency, and when we look at some of the results of transparency with several indices, we find interesting results that it may be highlighted or probably explore further. What I have here in this first slide is this is pretty much the same graph like you have on your left and in your right, is the DEG index, which Professor Eichengreen is one of the authors of this well-cited paper and very useful for all practitioners here in central banks. And I just using a paper by Asia and Doc, just classified it using on the in the y-axis I put the transparency index. What I put in the x-axis is the classification of the exchange rate regimes, and I put it like exchange rate anchor, monetary aggregate target, inflation targeting, and inflation forecast targeting. This inflation forecast targeting are the highest ranking countries. Is kind of an ad hoc classification, and you may see that there's this upward trend between these regimes and these regimes and these monetary policy frameworks and inflation targeting. Central banks are the ones that are ranked with higher indices. And what I have in the right side graph is the same thing, just put the mean and the standard deviation of this, and I graphed there India. So it's a really nice result that India is slightly above the average of inflation targeting countries. So these results provide that you can use, for example, Dinser and Professor Eichengreen index to set a benchmark against India. Remarkable transparency position can be compared. And also this is very important for things that are really fundamental when you're trying to 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 see the importance of inflation targeting, because when you have inflation targeting, transparency is key, because you need to have accountability and you have to manage that your policy is working. So transparency is key for these elements, as shown in the results of the paper. But furthermore, I just compared the results using other transparency index produced by ASIA and Professor Laxton and other co-authors, that is just focused on inflation targeting countries. It's not a general index, it's just more focused on inflation targeting, and it has like 3 blocks. I'm not going to go further in details with this, just saying that there's 3 blocks. The first one is transparency about the monetary policy objectives. The second one is transparency of the forecasting and policy analysis system, which is strongly related with the work that exactly the staff of the central bank presents the reports, and transparency about the policy process. It has these 3 blocks. And these are the results of India compared with countries that either in the Professor Eichengreen index or in DOC and Asia index for inflation targeting central banks rank really highly, which is Chile, Czech Republic, Sweden, and New Zealand. And you may see that using this index, India ranks quite closely to these leading central banks in these measures. But furthermore, just only not only the score of this index is interesting, but you may see like some places of further improvement. What I have here in this graph is the gaps of the transparency between in each of these 3 sections that this index has. So you may see that in section A, which is related with transparency about monetary policy objectives, India has a transparency gap of 37%. In section B, which is transparency of the forecasting and policy analysis system, that, as I mentioned, is highly related with the work of the staff of the central bank, it has like close to a 50% gap. And in section C, which is related with transparency of the policy process in this index, it has like a quite a relatively small gap. But using this transparency index, it may provide further improvements of transparency in India, using them as a benchmark of places where some improvements may be done, and that may help for the accountability of the inflation targeting process and for further improvements of monetary policy. And I just want to mention this related with the results of inflation expectations. When you have transparency, there's evidence that inflation expectations are more anchored to the inflation target. So this by itself is something that central banks with inflation targeting should follow, and it creates a better anchoring of inflation expectations. But this is particularly important in the case of countries that suffer adverse supply shocks related with weather or with other elements, because in this case, like communication of how these shocks, for example, contaminate inflation expectations, or how these shocks contaminate core inflations, is important to communicate to the public, to see how long they are going to last, how strong they are, if the monetary policy authority considers that they are going to be how they are going to last in the horizon. So this is interesting. And other thing with these measures of transparency is that when you improve in these measures of transparency and you use them as a benchmark, in my view, it creates or it makes easier the communication with the broader public, which is something that the central banks currently are trying to focus a lot, like trying to communicate to a broader set of people, like probably financial analysts, the financial system, they may understand what it's happening with the central bank, but this communication with the broader audience is important as well. And when you improve these transparency measures, it also creates a better communication with the broader public. And furthermore, these recent discussions on further improvements or changes in transparency, for example, what Douglas and Asya have been working on FPAS Mark II, is interesting, is important. I think that one thing that is aligned with what Douglas and Asya have been working on FPAS Mark II is, for example, alternative scenarios. And I think that is really nicely represented in the inflation reports in India, which is something that other central banks, we can learn from that. And thank you very much. I hope this was interesting for you, and it was an honor to share my views on your work.
Thank you very much, Jose, for your interesting comments. And I don't know if Professor Eichengreen or Dr. Gupta, you have any comments now, or should we proceed to the questions?
Only to thank Jose for the comments and bringing us around to the transparency and communication issues, which are something that I agree we could develop more fully in the paper. I was impressed in reading through all the reports of the Reserve Bank, how much information they do communicate, and I think your scatter plots confirm that the Reserve Bank does go to some lengths to try to communicate the rationale for its policies and its outlook to the public, both as a device for helping to anchor expectations, but also as a mechanism for accountability. And as well, the gaps you pointed out indicate that communication is not yet perfect. And there are things that might be recommended to refine how the RBI deals with its audiences.
So if I may just take 30 seconds as well. Thank you very much, Jose. As Barry said, it was a very, very useful set of comments, especially on the transparency part. One quick reflection, in the same spirit as Barry has said, inflation targeting framework has, I won't say has matured, it has overall worked very, very well. And it has anchored expectations. And it's done exactly the way as your comparisons show as well. There is a press meeting, there are releases of all the documents, all the questions are taken and addressed very, very patiently. But so in the gaps that you mentioned, so the gaps are with respect to expecting 100% transparency on a benchmark of 20. I don't know whether there's any country in the world which is meeting that is getting the full score. And if not, should the comparison be with the higher score, which seems to be 15 in at least the examples that you showed. So if you compare India's 12 with 15, that's a lesser distance it has to cover versus 12 to 20. So that was the only, reflection that came to my mind.
It's really interesting. I don't think like like a perfect score in every of these indexes is not an objective by itself, but it's a good benchmark to see what the things are done, and I think it may provide like good and good advice and good metrics on which points are really easy to measure. Just to give you an example here, because we have this discussion here in Colombia. One of the things that improves really easily the index, for example, in the central inflation targeting central bank transparency index is, for example, external reviews. And if the central bank has these reviews and publish to the people, that creates more transparency. Or forecast evaluation, which also I think is important to show to the specialist people. But I'm not suggesting that any country should have like a perfect score. So that is why the gaps, I think, are interesting, because it shows like in everything there's trade-offs. Probably there's some things that you consider that the cost of producing is too high, so you may decide that in some of the items is not worth it. But some items, for example, are not included in this transparency index and are important for the communication with the public. And let me give you one example here, also in Colombia, with the neutral interest rate. So in neither of these indices, publishing the neutral rate is important or gives any kind of transparency points. But we find out that here in the communication with the specialized media and the specialized analysts, publishing at least and actually I have to make this clear, is the forecast of the technical staff. It was important to give that information, highlighting that it has a lot of uncertainty, but also it creates it's something that in our report is published, and the analysts may see what the at least a benchmark of the neutral interest rate. So it's either, if it's not in this transparency index, probably something that in the case of Colombia, the policymakers decided that it was important in the process of their communication. So this trade-off of what do you want to show and what do you want to communicate is a specific in each country, but all these benchmarks of transparency, I think it provides useful information.
Thank you, Jose. Very useful.
Thank you very much. So we can now get some questions from the audience, if you don't mind, maybe one or two. But so please raise your hand if you have a question. But if you don't mind, I will ask one question myself. It's related to transparency again, because we did the work and we also worked with Jose last year. So we worked with our colleagues from the RBI, and that's how we got the index. So we discussed with them and so on. And my question is about the tolerance band, because as you mentioned, it is pretty wide. I think it's the widest among the central banks. It's usually 1% or 1.5, and in case of India, it's 2. So, and also that's one of the questions in our transparency index. We ask that the central bank explains what the word tolerance means. Does it mean that they do not react when the inflation is higher, like in the range or not? Because, for example, some central banks used that language before, but then they got rid of it because it makes communication more uncertain. So what do you think? Is RBI explaining that word tolerance enough, or could they explain it maybe a bit better, or and how it's affecting the inflation expectations in general?
Barry, do you want me to take this?
Please.
So the observations that I've had are that the RBI talks about the target more than it mentions the band. It keeps reminding everyone that my target is 4%. What the band gives it is an option to not react whenever inflation differs from 4%. There have been very, very few instances when inflation has fallen below 4%, which means though there is a band, 2 to 4%, it's almost as if it's an irrelevant part of the band. So then de facto, you're really moving between 4 and 6%. Now, 4 to 6% came in very handy last 2 years when inflation was high globally. And that's the time when the RBI chose not to react when inflation remained higher than 5%. Has it unanchored expectations among the specialists? Not really. So the professional forecasts remain between 4.5% even in the medium term in the next 1 to 2 years. And again, this band 4 to 6% range has given the RBI a way to predict its inflation at 4.5% even as late as next year, but not to react to that too much. So it has been, I mean, in the paper we debated quite a bit about exactly this feature of the inflation band, that it's too wide. One view we considered was if 2 to 4 is in a way redundant, India is not expecting its inflation to come below 4% on a persistent basis anytime soon. Should we still recommend to keep that part of the band? And we ultimately chose that, given that last 3 years have been really very, very challenging for every country around the world, given that in the last 2.5 years, it has been hard to bring down inflation for a long period of time to 4%. Any benefit of doing away with the lower part of the band or narrowing the band, any benefits would be outweighed by potential unanchoring of expectations in some ways, or losing the credibility that has been built. So until a time comes when inflation can be around 4% for a reasonably long period of time, the status quo prevails over any change. So I'll stop that, and Barry, you may want to come in on this very important question.
So I think about the band as an important communications device toward the beginning of the inflation targeting period, when the RBI was telling the public and professional forecasters that we're aiming for a 4% inflation rate, but you shouldn't expect inflation to continuously hit 4%. It will fluctuate in this range. And the Reserve Bank is committed to try doing its very best to keep inflation in that range. Now that the regime is credible, discussion of the range is less relevant, but costs of altering, as I put it in the presentation, tampering with the framework may be non-negligible. So it's an inheritance from the past, but I don't think it has significant costs at the same time.
Thank you very much for the comprehensive answers. So I think we're out of time. So and I would really like to thank you for a very interesting presentation, and Jose for your interesting comments. And thank you very much for accepting our invitation. So I guess we will call it a day, and I wish you a nice weekend.
Thank you as well.
Thank you very much. It was a pleasure.
Thank you. Have a nice weekend.
Thank you.
Thank you. Bye-bye.
Bye.